It's time now for another episode of the Bank Free Blueprint Podcast, where you'll discover how to collaborate with an abundance mindset and work together with others to create amazing results in real estate. Get practical, hands-on deal structuring advice, strategies, and ideas that have been used to fund over $200 million in deals. Here's your host, Tom Braegelmann.
Welcome to another episode of the Bank Free Blueprint Podcast. Today I have with me a special guest and friend. He is a private money lender now. He's a father of two, a married family man. He lives in Tampa, Florida. He was born and raised in Kentucky. In 2002, he decided to join the Army, and over time, in I think it was 2010, he decided he was going to do something that was maybe a little bit tougher, and so decided to join the Green Berets. So with us, we have Edwin Epperstein. Welcome, Edwin.
Hello, Tom. How are you? Thanks for having me on the call.
Oh, absolutely. My pleasure. So quite the background, 13 and a half years in the armed services, and then now a private lender. That's a bit of a jump, but it is, I can only imagine. Well, I know you personally, and I know the discipline and the tenacity and the attention to detail that you have in your business, because you and I have definitely had opportunities to mentor others together. And so I know that part of you, so I can certainly see that value. What was it that got you started as a private lender? And if I missed anything in the introduction, certainly I'd love to have you fill it in as well.
Well, I definitely appreciate the intro, Tom, and thank you for having me on the call to all your listeners and viewers. Again, my name is Edwin Epperson. As Tom mentioned, I joined the military. I'm
sorry, I put a T in there, didn't I?
No, that's okay.
Epperson, sorry. Gotcha.
I did join the military in 2002, and going from a combat arms oriented job to more of the financial world is quite the jump. Mm-hmm. I guess you could say I started that progress after I read Rich Dad Poor Dad, and like many people, I wanted to jump into real estate investing, and I did that in 2008. Mm-hmm. I lost my shirt. It was a great year to get in the market, by the way. I mean, there were
lessons learned.
Dripping
right?
With sarcasm.
Yeah. Wow.
So after I licked my wounds, I came across a gentleman named George Antone, and he had a book called The Banker's Code. Mm-hmm. And he had a live workshop event, and something about becoming the bank really resonated with me.
And that's actually where you and I met.
Yes, exactly. That's exactly where it was. And so that was in 2011, actually. And excuse me. I'm sorry. When I went to the live event was 2014. I bought George's book and his at-home study course in 2011. So from 11 to 14, I was involved with the special forces, and we do a lot of deployments. So being able to really launch my business in real estate investing, becoming the bank, was not really that feasible. However, I was able to do a few very small loans to gentlemen that I worked with. Mm-hmm. And it occurred to me, it was our deployment to 2014 Afghanistan, that I could really do this business anywhere. We were sitting on top of a mountaintop, and we were observing a village that we were going to go in and assault the following morning. There were some known Taliban leaders there. And I was on my computer. I had just sent off an email via government satellite. So don't know how legal that was, but I closed a loan. It was a small loan, but I closed the loan working with the closing agent that I had built a relationship with. And we did a very small loan. And I realized I can do this anywhere. And so after that deployment, I had a rough deployment. We lost some really good friends. And so I came back and I had a discussion with my girlfriend, wife now. And I said, there's this opportunity investing that I'd really like to take hold of. And there's some further on training. And I'd like to know if I have your support. She said she did 110%. So I came out, and that's where you and I met, Tom, in July of 14. Mm-hmm. And then right after that, I started to really step up my business and get it operational so that I could get out of the military and do this full time, which I did in October 2015. So in October 2015, I've been doing this full time and have not looked back. So
wow. Yeah, quite the journey there. You've always been very collaborative. We really encourage collaboration, abundance mindset, all of that. And
Absolutely.
one of the things that you've done a lot of that is helping other investors, other private lenders, other people in any sort of real estate investing, not only helping by way of financing projects or that type of thing, but also just by way of giving back, by way of mentoring and showing people some of the lessons learned and whatnot. And
I've got a few of those.
yeah,
As we all do.
right. A couple of the things that I particularly remember and associate you with is the discussion. And I remember you were speaking at one of the workshops and you were talking about the power of absolute responsibility.
Absolutely.
That everything, absolutely everything stops with me. Could you just share a little bit more on that?
Actually, thank you so much, Tom. That's sort of my mantra for my business, my personal life as well, but also my business. The book is actually based on a book. The concept is ingrained into the special operations community because there's no room there's no, your life depends on excuses and not having excuses. So this idea of extreme ownership is ingrained in us. And I wanted to translate that into the business world. And there is a great book for all your viewers and listeners. It's called Extreme Ownership. It's written by two fellow Navy SEALs, Jocko Willink and Leif Babin. Great book. If your readers want a mindset book, that is a phenomenal mindset book.
Excellent. Well, for anybody who's listening, we'll be sure to get that put in the show notes so you'll be able to get it. So Absolutely. If you're driving, don't worry about having to write it down.
Yeah.
But we'll get that in the show notes.
So that extreme ownership mentality is really how I've approached this business. And that all that says is that you cannot make excuses for extenuating circumstances that most people say, oh, well, this is out of my control. But,
yes.
I lost money because this and this and this, it was completely out of my hands. Or I made a bad investment because of this and this and this, but it was out of my hands.
Mm-hmm.
Even if you get scammed, even if you have somebody else who was in charge of something and they made bad decisions, guess what? It always rests on your shoulders. Yes. That's how you have to approach it. And if you do that, you will gain the trust and respect, which is the currency in any business.
Yes.
The currency is trust and respect. Money is it is the result of trust and respect.
Mm-hmm. Mm-hmm.
And so the trust and respect is the currency of any business.
Mm-hmm.
I know that money, people look at money as like, oh, well, that's the point. And it's not. The monetary money is simply the result of that trust and respect that you build. And extreme ownership builds that into your life, your personal life, and your business life.
Yes. And when you think about the word responsibility, what is it? It's the ability to respond, responsibility.
Yeah.
And so if we don't do that, if we aren't responding, if we aren't taking responsibility for everything that we do, the opposite of that is to become victim, to have Absolutely. A victim mentality. And so I think that's really powerful that no matter what we're doing, if we always take ultimate responsibility for it. So that just have to say that was something that really rang true to the way I felt about things when I heard you talking about that. Another one was, another thing you spoke of was complete transparency, being dedicated, being committed, being loyal. So when just for some of our listeners, we have listeners that are just beginning in real estate. They're just starting out with, maybe they have a deal that they're looking at, they want to get funded. Or we also have some that just have deals that are ready to get funded. They know it's really good and they just need the last chunk of capital to make it work. We have listeners who have money, passive investors who just time is limited, but they have money available. And so within that spectrum, what you do as a private lender, it's more or less dealing with that full spectrum of people. But let's start on the borrower side or the developer side. So this can work as a joint venture or a borrower-lender relationship. But when you're looking at a project, let's say somebody brings you a project. what do you look for on that first pass? What is the process if somebody has something that they want you to look at that you potentially could fund for them?
Well, that is an excellent question. My first look, obviously, is going to be, does the project fit within my capabilities? There's a lot of great projects, and people have many great projects. But for someone like myself, we're really operating in a small niche. So we need projects that fit within that niche. Anything really outside of that, we could find ourselves in trouble because we don't really know that area. Or we could, even worse, potentially put you as the borrower, whoever the borrower is that is looking for those fundings, we could put them in a bad position because they are relying on us to do our due diligence and understand, hey, if I'm getting into this deal as a lender, then obviously this is going to be the type of deal that the lender sees as is worthy of the risk.
Okay, so what I'm hearing there is that the first step is really to understand what your criteria as the lender is. And so there might be investors who have money and they're looking to invest with somebody who's active, who has a deal. The first thing, and this is something we talk about in the Bank Free Blueprint book, the first step is to set criteria, set your lending criteria, set your investing criteria. And if I'm hearing you right, that's you have your criteria set, you have your guidelines, you have your boundaries of what you will or won't do. And so that's where you start. Right?
Absolutely. If your viewers have, and you find this a lot, people that have capital and they want to invest in real estate because intrinsically we understand that there is good, solid potential within real estate. So people want to invest in real estate. They have money, but they don't have the time, they don't have the experience, or they don't have the knowledge. Those are what I call the 3 key factors to becoming a successful real estate investor. And if they don't have those, but they have the money, what they're going to end up doing is partnering with somebody or loaning money to someone. And if they don't have their criteria, their guidelines established on this is what I will and will not, and stick to those, they're going to find themselves in a world of hurt. Absolutely.
Right. So you and I both know that there's a very extensive list when it comes to building criteria when you've been in business for a long time. What are the criteria we will follow and won't follow, and what fits and what doesn't fit? Can you maybe just give the top, 5, 6, 7 criteria that you use so that people can at least get an idea of what we mean by setting criteria?
Absolutely. So one of the things that I'm going to look at is the person who is borrowing my money. Is it an individual or is it an entity? And that can be a trust, that can be an LLC or some corporation. I will only loan to entities. I will not loan to individuals. Even if the individual is only going to use the property for investment purposes, there is that additional layer of protection that myself as a lender requires, that being an entity. One of the other guidelines that I like to look for is a low loan to value, meaning I have people that come to me and say, well, I'm buying this property for $100,000, but it's actually worth $150,000. And then after I get done, repairing, it's going to be worth $300,000. So because I'm purchasing it so far below the as is value, I should get 100% financing. And one of my guidelines is that I always have to have skin in the game from the borrower. If you are a lender, you have the capital, you're looking to make a loan, that should be maybe something that you should seriously consider, because when somebody has something at risk, it is much harder for them to walk away from that project. So even a little bit, just having the borrower having something more than their name on the paper, it means something.
Yeah. So I'm assuming, for instance, if they're a contractor and they say, well, I don't really have any money, but I'll do the work for a huge discount. I believe I know the answer to that question. But what's your take on that?
Tom, I've actually gone down the road that I probably shouldn't have by saying, oh, well, that's great, because I'm thinking this gentleman's going to put his sweat equity, right, into this project, and that's going to be great. The problem is, as a lender, sometimes we get caught up in looking at the investment from the borrower's perspective, from the borrower's eyes. And so we're seeing all this upside potential. As a lender, our primary focus should be covering your downside. The biggest downside risk that is, if let's say the renovation is going to be $100,000 and the contractor says, well, out of this 100,000, 25% of it is actually my gain, like what I should be earning. So the cost of actual outsourced material and labor is going to be 75,000. So how about we just do 75,000 and I'll eat it until the back end? That's fine and dandy until something happens to that contractor. And now you have to step up and start hiring out these sources, and you don't have those connections. So
you don't have the connections, you don't have the capital. You end up putting more of your own capital into it, or bringing other investors along, and it just creates a whole nother set of challenges to get to that next level. So I totally agree with you on that one. So what is there a certain percentage that you try to have as far as skin in the game? Is it 10, 15% of the total capital?
I like, ideally, the more the better, right? Obviously, if somebody is concerned about rates, interest rate, what they're paying for the money, the cost of the money, then the more they put in, the lower the rate is going to be. Of course, that always goes against, like, they're trying to leverage the money that they have, so they don't want to put that much into it. So I like to see anywhere from 10 to 20%. I'm very open, flexible with that. I like to see 10 to 20% of skin in the game on the purchase price.
Okay. Got you. So we've talked about skin. We've talked a little bit about loan to value, and I just want to clarify something there, that if there are investors that are working on a joint venture structure, maybe rather than a borrower-lender relationship, the loan to value, another way of looking at it, the way I look at it, is equity to value, or the amount of cash, or the amount of protective equity.
Yes.
So even though it may not be a loan, it still is a certain amount of investment to value. So there's an equity piece, and we always want to make sure that equity piece is big enough so that if there's a downtick in the markets, or if something doesn't go as planned, there's some buffer, some protection there. So we've got loan to value, we've got skin, we've got, how about size of projects or types of projects?
Yes. So, and I know, Tom, that you're in California, so your all size of a project is going to be significantly higher than where we're at here in Tampa. I only do loans in Florida, so I don't do anything outside of the state of Florida. My typical loan size is anywhere from $150,000 up to $300,000. Now, I have gone above that, and I have gone below that. There's circumstances when we can talk. I'm very relationship based oriented. That's the way I like to conduct my business. So it's not just a check the block type thing. However, there are certain things that we need to check. But yes, my average size is between 150 to 300.
Okay. And single family, non-owner occupied typically?
Yes, always.
And non-owner occupied because of?
Because of your laws when it comes to owner occupied, which the government will look at, or your local state legislator will look at, being consumer type loans. So if you have money and you're looking to loan money, or even if you're a borrower and you're looking to borrow funds, but you're wanting to live in the property, fix it up, and then turn around and sell it, and you'll move to the next property. What happens is, even if we do a commercial loan, meaning it's written on a loan application that is commercial loan application, and if we make that loan and you're living in the property, if God forbid something were to happen and we had to go through the foreclosure process to take that property back, there could always be the red flag that the borrower could throw up that says, oh, well, this breaks conventional wisdom, or conventional practices. So to avoid all of that, we say only to entities will we make a loan, and they have to sign a affirmation of use, which basically they hand right in. I will not live in the property. I will not occupy the property while it's being renovated.
I see. Okay, so let's say some of the listeners have a project. How would you recommend that they submit projects? What's some advice you can give them? Whether, I know you only do deals in Florida, but let's say they're in any one of the other states or in Florida. What do you recommend when they go to talk to the potential money partner, the potential private lender, or the hard money broker, whatever it is? Any advice that you can start out with?
Absolutely. I will say, you've heard the saying that cleanliness is next to godliness, right? Organization is next to professionalism. So you, as the person who is going to be, you're out there raising private capital, you're trying to get a loan from a private lender, someone who's not institutional. you come across as being professional, even if you've only got 1 or 2 deals under your belt, or even none. You can come across as very professional by the way you present your opportunity, the way you present your numbers, the way that you have everything well thought out. And I know that there's this fine line of you're trying to balance, okay, I need the capital so I can get I need the letter of intent so I can actually get the property under contract. But there's still a level of professionalism that we expect the borrower to step out on a limb and do certain things so that, hey, they're presenting a good solid package, and it makes it easier to go ahead and say, you know what, we'll look at funding. One of those is your basic documents, such as, having a driver's license, a photocopy of your driver's license in a digital format. Like, there's some things that as a borrower, you should have on your Google Drive, your Dropbox, your Box account, whatever it is. You should have your driver's license. You should have your letters of or your articles of organization or articles of incorporation. You should have operating agreement, or there are standard documents for your entity that you should have like digital copies of. That way, when a lender says, this looks interesting, you can go ahead and send them over that immediately. And it's like, wow, okay, this guy's got his stuff together, or woman for that.
Yeah. So creating the good, solid, full, complete package.
Yes.
Organized, detailed.
Yes.
And now, even though that's brought in very organized and detailed, you go through a certain process yourself.
Yes, that's called underwriting.
And
yes,
can you describe what that would look like, and any pitfalls or anything there?
Absolutely. So our underwriting is basically a verifying and confirming of all the information that the borrower is providing us. So when the borrower says, hey, I've got a company here in the state of California, and then, I've done so many loans. Well, what all we would do, Tom, is we'd go on, we're looking for proof of whether this person has actually done work in the past, like they say they have done. We're looking for the fact that their entity, where it's registered, who the registered agent is, who all the members are actually lining up with who they say is in the entity. That's what the underwriting really is. It's a checks and balances of all the information that the borrower is providing. And it ultimately, in our business, it ultimately comes down to the asset. So what is the valuation of that asset? Because we want to know what the value is right now. We want to know what the future value potentially could be. And what's really important, and I know that this is important for you, Tom, because you do loans on new construction and big renovation projects. I do renovation project loans. Our biggest key factor is, okay, what is the contractor's scope of repair or scope of work? And is it in line with the actual going rate? Because of, again, going back to your one scenario where the contractor says, well, I'll eat these costs and just get my profit on the back end. But what happens if something happens to that borrower and that contractor, and all of a sudden he way underestimated the actual cost of that renovation or build out, and now we've got to step up and come to the table with more money. So
yes. So the asset is absolutely critical. The knowing the numbers, the budgets for the construction, and performance is another one. You hit on something about the profitability, and this isn't quite how you said it, but what I want to get to is the profitability of previous jobs or the success of previous jobs.
Yes.
One of the things that if you're a borrower, if you're listening, and one of the things that we as underwriters look at is the track record, but there's also one step before that, and that is the credibility of the borrower to be upfront, open, and honest about what they're doing. So sometimes we've had the occasion where we've asked the borrowers, the developers, what they've had for track record for sales, or whether the deals were profitable, and we get told one thing, but then as we get close to closing and we ask for copies of HUD statements that show their previous closings, that show that there is profit there, or that it's not at a loss, or that it performed, whatever that might be, that's definitely a checking point where we can check on the credibility. So I'd much rather have somebody tell us that they got into a project that was over their head and they didn't make money on it, or they lost some money on it. I'm a lot more likely to go down that path with them if they're open and upfront on it, rather than find out later that these deals that they said they did and were profitable Now all of a sudden the HUD statement shows something completely different, the closing statement. And so just to get a step ahead of that as a developer borrower, I would even suggest that if you're submitting a package to a lender like Edwin, submit those HUD statements right up front. Be completely transparent, be completely open and honest, because when there are issues that come up, we can deal with them if we know them, but when they come up sideways or they blindside us, that's when credibility really is at stake. And any thoughts, anything come to mind on that?
I 110% agree with you, Tom.
Mm-hmm, mm-hmm.
I think that is so critical. One deal that I made a mistake on was taking the contractor's word that he had been involved in all these projects. He even drove me around the local area and showed me I was involved in this project and this project and this project. And I did not ask for proof of that. Mm-hmm. Obviously, I'm sitting in the car with them. We're getting to know each other. And I thought, well, he did this. He had his hand in there. What it was he was simply a day laborer. He had worked on the project, but he had not managed the project. And for your borrowers that are looking to make that transition from being a tradesman, they're specialized in a craft, and they want to step into the world of actually owning the property and doing the renovation, there's this management piece that is absolutely critical. And there is a leap in capabilities from someone just being the plumber or the electrician or a framer or a roofer, and going from that job to actually managing the entire project. And it does take experience to do that. So for your listeners and your viewers, being able to double check via the HUD-1 statements, proof like that is verifiable proof that they are the owners of the company, and the companies that they are borrowing money from you from have actually bought and purchased and sold properties before you. Absolutely.
Yeah. And so again, this isn't just for one or the other. It's for if you're a passive investor and you're looking to get into a deal with someone, really knowing what to look for, what to ask for, where to watch for red flags, where to watch for inconsistencies. And if you're on the developer side, the borrower side, and you really want to get your project done, submitting a very complete, like you said, Edwin, complete detailed package and being able to show, to connect all the dots for that passive investor beforehand or that private lender beforehand, it just creates so much more credibility for the entire project, for yourself, and it makes it so much more likely to be a project that can be funded. And by doing that, you're not fooling yourself either. So by creating that full package, by proving it out, you know that that it's solid, that you are doing everything, and you're not kind of just winging it a little bit here, a little bit there, and then in the end, hopefully it all comes together and there's profit in the end. It just doesn't work that way. And so we've talked about the credibility, the transparency, the trust. Any other thoughts from the developer side of the equation or the active investor side, where they're bringing the project to a passive investor? Anything that, and I know we talked about some of the criteria, but anything else you want to share from that perspective?
Know your numbers. I cannot tell you how many times somebody's come to me and they're just, it's like they're ad hocing these numbers, or myself as the lender, I start to delve into the numbers, get a little bit deeper into the renovation, the cost of that, their exit strategy, and the numbers don't work. So then the borrower goes back and says, oh, well, I can adjust this and this and this. As the person who is getting a property under contract to renovate it, the only cost that you should be looking at adjusting is your purchase price. Because if you've gone into a project and you're saying, hey, it's going to be this much to renovate or build out, and then I come to you and say, well, we need to do the total cost of the project needs to be this much. And the first thought in your mind is, oh, well, instead of going with this, I can go with this on the renovation. And instead of doing this, I can do this.
Cutting away.
You're cutting away from the very thing that is going to get you at that maximum sell price. So that's the biggest struggle I see with a lot of investors and even experienced ones. They hate to go back and tell the seller, for fear of falling out of contract, for fear of a lot of things, but it boils down to your money is made on your purchase. And if you're negotiating well enough on your purchase, then you're going to have enough fluff in there for whoops factors on the rehab or your bill.
Yeah. Okay. Good advice. So now let's go to the other end of the spectrum, but along that way to get to the passive side, maybe can you describe as a private money lender what your position is and how? So you are acting sort of as a middleman between the money. I mean, I know you invest your own money too, but you also, from what I understand, from what we've talked, you bring in other people's money alongside of you. Can you just describe a little bit of what that looks like for our listeners?
Yes. So one of the things that getting into this business is I worked with guys in the military and special forces, and we would go overseas, and there were guys that had the experience and they had the knowledge in how to do these renovations, but they didn't have all the capital. And so they would come back and I would talk to them, find out about their project, and then I would go to guys that I had been in the military with, and we would figure it. Now, back then it was very rudimentary, as a lot of trust, because they would basically give me their money. And then once I had their money, then I would make the loan. I don't do things that way anymore. I think there's a lot more fiduciary responsibility that needs to be in place. And so I have found a method and a system to do that. But yes, that developed into I call them partner investors. My partner investors, they began to see that they didn't have to have all the knowledge, experience. They had capital that was sitting around. Maybe it was underperforming, or maybe it was locked up in a bond or a CD. Maybe it was in the stock market, and it was exposed to a lot of risk. And so they wanted it tied to something more solid, more stable. And so they heard what I was doing through their friends. So a lot of it's grown word of mouth. And, they started coming to me and finding out how they could get involved with me and becoming the bank, because it sounds very attractive. And it is very attractive. You're able to control and mitigate the risk, it suits my nature. I like to control and mitigate my risk. If I can do that, then I'm moving forward with a lot more confidence.
Gotcha. Okay. And so if you're talking with someone that's interested in investing alongside of you, how does the conversation typically go?
So typically the conversation will go, we're just simply talking to each other about what we do. And if I'm talking to somebody who's never met me before, it's where it normally falls. They ask what I do, and I tell them, I'm a deal sponsor. I'm a financier here in the state of Florida. And those two words always strike a quizzical, what does that mean? And so then it allows me to tell them what I do. And if there's interest, then there's following conversation. But the point of it is that I want to get to know them. I really want to make sure that they understand what I'm doing before we go together and start working together. I think that that's a recipe for disaster. Communication is that is a bedrock for the way that I conduct myself. And so clear, concise communication revolves around, I know what you expect, and you know what I expect. And it's a mutually beneficial agreement. It's a mutually beneficial understanding. And so it develops out of that. And then, after no set period of time, sometimes it's several months, I've got people who have just sort of asked me for the past 2 years on and off. So what are you doing now? What are you doing now? There's no, I guess, really recipe. It's just whenever somebody feels that this is something they want to do, and I have an opportunity, and they want to participate, then we can cross that bridge at that point.
Okay, and you have a way of structuring it so that they can basically invest alongside of you in what you're doing in the projects.
Yes, we do. We have a way that's unique. It's very unique. I've talked to a lot of bankers, attorneys, and over I've heard them say that they have never seen anybody doing this. Now, of course, this is here in Florida and Tampa, but they've never seen anybody doing what I have set up. And they overwhelmingly have said that has to be one of the most well thought out ways to protect your partner investors, because you are removing as much risk as possible. Like, I don't touch people's money. That's one of my requirements. Which is unique in this industry, because a lot of people are like, hey, give me your money and I'll do with it whatever you want. And so that's one of the things that I've established.
Yeah, that's great. If you could tell Let's start with the passive investor, the we'll call it the money partner, the person that might invest alongside of you. If there's one thing you wish they knew or wish you could tell them, or what comes to mind?
That this is real estate. Very seldom do things go exactly as we plan. And that is why there are people like myself, like you, Tom, that have taken on the burden of responsibility to say, you know what, it may not go exactly as we plan, but we are going to see this through from beginning to completion. And we are here to make sure, in the best of our ability, that the investments that are being made are done with full disclosure, are being done with full vetting and underwriting, and that at the end of the day, we have a very well thought out plan on how to get from point A to point B, which includes the return of principal and the return on principal or return on capital.
Yeah. Okay, great. And so the idea that this is just a simple piece of cake.
There are a lot of, and I know you know this. I know you know this. There are
you know where I'm going with this, right? Yeah.
And you know what my partner investors see is a very nice, laid out, well thought out plan. But in there, and I want to simplify it because all this information will become so convoluted and it can confuse a lot of people. And so I simplify it. I don't hide the information. I simply simplify it. And I, again, then it falls back to the communication. If the communication is not there, when things, not if, but when things start to go a little curvy, sideways, or even south, that communication is constantly there to allow my partner investors to feel comfortable that, hey, whatever's going on, Ed's on top of it.
Yeah. And just to know that there are a lot of things there are a lot of moving parts in this type of business. How about from the active investors, the borrower or the joint venture partner who's active, the one that has the deal? Anything that you'd like, if you could share one thing?
That there is, active investors, they want three things. They want 100% of the money, they want fast money, and they want cheap money. And unfortunately, you can't get all three of those. You might be able to get two. More than likely, you'll at least be able to always get one. So your institutional lenders are going to be your cheap money, but that's about it. That's all you're going to get from them. But it's going to be slow, and it's definitely not going to be all of that. So when you're dealing with someone like Tom and myself and other private lenders, you're able to capitalize on one or two of these, but you're not able to get all three. So as an active investor, please understand that we're doing our best to help you be successful, because when you're successful, we're successful. But our primary goal, our primary responsibility is to underwrite, control, and mitigate risk. And so when we see what we deem a potential risk, we're going to try to work with you. It doesn't mean that we're like backpedaling or crawfishing, as people in Louisiana would say. We're not trying to crawfish out of the deal, but we do see a potential risk. And so we are wanting you to help us control and mitigate that risk, whether that includes we need to see further license, we need to do a background check, we need more capital to the table. We need to restructure the way that this portion of the draw is going to be set up. We need to restructure this. We're just asking that you guys work with us, because in the end, this is a relationship business. And I know, Tom, that when you find somebody who is on their P's and Q's, who is out there and they are hustling to get these projects, they're putting in their time, they're putting in their money to make these projects happen. That is a valuable relationship that you and I absolutely want to maintain, keep, and grow. And to get to that point to where you have that trust, where your active investors have that trust from you, there's some trial, there's some error, there's got to be a proof of experience. But once that happens, man, the doors can really blow open for them.
Yes. Excellent. That's great. Any particular resource, book, website, whatever it might be, anything that comes to mind that you think could be really valuable to the listeners, whether they are on the active side of the spectrum or the passive side of the investing spectrum? What comes to mind for you?
Well, I think on your active investor side, they can always go, if somebody is looking to do a loan in the state of Florida and they're an active investor, they're getting a property under contract, or they're looking for a property under contract, they can always visit our website, which is www.spearsoninvestmentgrp.com. I think some other really great sources for active investors are going to be your Bigger Pockets websites. Mm-hmm. Going to the social media. There's some great groups within Facebook and LinkedIn in their local area. So finding those local groups, meetup groups. I know that you host a meetup group in the Bay Area. So you've got groups like that will allow your active investors to plug into their local economy and really build those networking and relationships to help them grow their businesses. Good.
And we'll be sure to get those links in the show notes again, along with the book that you mentioned earlier. Any last thoughts? I know that if somebody wants to reach out and get a hold of you, what's the best way for them to reach you?
Yes, the best way to reach me is either my office line or my email. Email is edwin@SpearsonInvestmentGRP.com. Okay. And then office line is 813-474-4429.
Okay, great. Yeah, so if you're listening to this or watching this and you have a project that you think might fit for Edwin, and it's in Florida, or maybe even if you just have questions for Edwin, I bet he'd be open to taking phone calls and help you out with questions that you might have. Or if you're more on the passive side of the investment spectrum, and you're looking to maybe team up with somebody to put some investments in, certainly reach out to Edwin. I just say along with that, if you're enjoying the podcast and if you're enjoying what you're hearing, and you think it's valuable, I'd really love it if you'd be able to share it. We want to really grow this podcast to the point where it helps a lot of investors. Originally, I started the Bank Free Blueprint concept, the book, and the podcast, because I think that there are so many things that we've all learned in the business that we can share with other people that makes it so that others don't have to go through the same mistakes that we've made, that we can help lift everybody's boat up. And it just by collaborating and working together, it just really helps everybody do that much better. It's
absolutely
a cycle of abundance. And so if you like what you're hearing, would love to hear that. I'd love it if you could go to iTunes and leave a review, tell your friends, and if you have comments or suggestions or anything that you'd like to share, or if you have a guest that you'd like us to try and get on the show, just let me know you can email me at tom@tombraegelmann.com. Again, tom@tombraegelmann.com. And I'll be able to answer all of those, any questions that you have. Edwin, this has been a real pleasure. Great to have you as a guest, and definitely looking forward to a lot more working together.
Absolutely, Tom. I appreciate it. Thank you for having me on your show.
You bet. Thank you.
Thanks again for listening to the Bank Free Blueprint podcast. If you haven't subscribed yet, you can do so on iTunes or Stitcher. Be sure to send us comments, questions, and suggestions to feedback@tombraegelmann.com. You can also visit tombraegelmann.com for a complete listing of all recorded episodes. Thank you again, and we'll see you next time on the Bank Free Blueprint podcast.